All right. Hello again, everybody. This is Mike Rixey. I am the lead options instructor for NetPicks, and this is our options trade of the week. We will indeed get over to that new trade that's catching my eye for the next week or so. We'll get over there in just a moment. But before we do so, I want to talk through some big key levels that are coming into play market-wide. The last 2 weeks has been a pretty interesting stretch, right? Pretty wild ride in both directions. We've had big volatility. The VIX touched 34 here early in the session today. A lot of fear being priced in. And if you're one of those people that likes to pay attention to financial media, you guys are hearing all the big headlines, right? Recession fears, inflation numbers continuing to come in at decades highs. We're seeing interest rates finally start to rise. The Fed is finally starting to take action. They're way behind the curve, in my opinion, but they're starting to raise rates. As a result, we're seeing all of that uncertainty priced in for the first time in a long time. If we go back to last year, there was no fear. The rates were at zero. The Fed was very accommodative, and now they're starting to pull back. So now it's a true test of this market because it doesn't have all of that stimulus. It doesn't have rates down at zero. Even though rates are still historically very low, the Fed has made it very clear that they are going to continue raising those rates in an attempt to fight these out of control inflation rates. So what does that mean for us? Well, the big challenge that I'm giving to our students right now is to try to block out as much of that noise as possible. What we have to realize is that headlines sell, right? News sources want the eyeballs on the headlines. They're going to sell fear. And it's really easy to get caught up in thinking, a doomsday scenario is upcoming, right? What we want to focus on is making decisions based off the numbers and statistics, right? If I came in and traded off of the headlines, I would be 100% short, right? Preparing for that doomsday scenario, when in reality, we're very oversold and we're probably due for a bounce over the next couple days. I have to be open to taking trades in both directions. I don't want to fall into that perma bull or perma bear camp. I want to be open to anything the market is throwing our way. When I pull up this daily chart of SPY, this is the one that I like to use for overall market sentiment. And if I take a look, there's no doubt about it, right? The market has been in this downtrend, right? I mean, the last month or so, we've had some nasty selling. But we're at a point of interest on the downside to where in the near term, what I classify as the near term, the next 2 to 10 days or so, we're probably going to see an attempt at a bounce. When you start to talk about a bear market, the bear market rallies can be vicious. They can come out of nowhere. So we have to be prepared for that. Right? Am I expecting the market to zoom right back up to the highs? No. But are we going to potentially get a tradable bounce to the upside? Yes. Not only are we oversold, there's a lot of people that are short. If we do get that bounce to the upside, you add in some of that short covering, and that's when you get those powerful pushes to the upside in a bear market. Just because we get a bounce for the next 2 or 3 days, if that happens, does not mean I'm calling the low and just gonna go all in on the bullish side. It's not it. I'm just looking for a potential trade on the upside. The low from yesterday down at 394.82, that's our near term point of support that we're tracking. Below that level, I'd be looking at 394, 393, and 392. Those would be the big areas of potential support should we get another leg to the downside. We continue to see a lot of the rally attempts sold. We're seeing that again here today, specifically in the NASDAQ. It's really difficult to hold a rally. And I'll talk about some of those intraday numbers in just a moment. If we do get a bounce, if we do end up getting that short covering rally like I just brought up, the first area that's of interest to me on this daily chart is the 8-period EMA. It's that pink line on the chart. It's currently sitting at 408.70. That would be the first area that I'd want to watch. Can the bulls take it up through that level on a closing basis, or are we going to touch it and reverse right back to the downside? Now, obviously, we have some work to go to get close to that level. It's not just going to be a couple hours of buying. We need to see some sustained buying. So that's the big question mark. Can we get that here potentially over the next few days? The volume side, the volume's been phenomenal the last few weeks, which makes perfect sense. And normally we see the volume spike on the downside, and we're getting that, right? The volume's had no problem getting up above 100 million shares now for the last few weeks. That should continue as long as the volatility stays active. The ATR, the average true range, you can see down at the bottom, is above 10. When I see the ATR this high, it's normally indicative of a day trading type environment. It doesn't mean you can't swing trade. It just means the moves intraday are very, very large. They're much larger than normal, and you have to be cautious, specifically with where you put your stops at. It's very easy to get whipped around in this market because the moves are so big. These are moves that are happening in a few hours that used to take a number of days. So you have to be cautious. What I'm recommending that you do is, if you're one that likes to stay very disciplined to a set stop on all your trades, move those stops out a bit. And if needed, To compensate for that, reduce your position size a bit, right? Just give your trades more room to breathe so you're not getting caught up in these big back and forth choppy moves, right? I mentioned the VIX above 30. It's a pretty good number. I mean, historically speaking, when you start to see the VIX in this range, and we've had the VIX high now for the last number of weeks, you can see it here. I mean, if you go back to late April, we saw the VIX get down to 20, bounced up, and it's basically been above 25, 26-ish for the last number of weeks. It's very unusual to see these types of extremes on the VIX last for weeks or months at a time. That's why I continue to believe that we will, in the near term, start to get some relief on the upside in equities, which would also lead to the VIX contracting. Oftentimes when volatility spikes, it's overstated. People panic. People just say, hey, get me out at any price. And as a result, the volatility gets high. Oftentimes it's overstated and it'll normalize, which I'm expecting here in the very near future. Again, I'm not expecting a huge move back up to the all-time highs, but I do think a relief bounce in equities with a contraction and some volatility in the near term, there's a high probability of that being in the cards here in the near future. So what does that mean for us as far as new trades go? Let's transition on over to what I'm looking at on an individual chart basis. What I just got done talking through on the daily chart, that's what I use to gauge market sentiment as a whole. But that daily chart is not a chart that I'm trading off of. I like to narrow it down to some of the shorter time frames to really ideally identify those entry and exit points on a shorter time frame. For that, I like to use the 130-minute chart. And I'm looking at Apple. The tech stocks have been really beat up. They've been very, very weak now for the last number of weeks. Been very, very difficult to get any type of sustained bounce. We know if the market is going to move higher, if we're going to get that short covering rally, we really need to see the tech names, specifically Apple, Amazon. If you throw Tesla in there, Microsoft, we really want to see those big heavy hitters get off the mat a little bit. If I take a look at this 130-minute chart, our pulse indicator down at the bottom on Apple, you can see a whole slew of yellow bars there. What does that indicate to me? It indicates that price is between a 1 and a 2 standard deviation move on the downside. That means when I hit a 1 standard deviation move, in many cases, it will lead to a point of exhaustion because I know that past that, only 13.6% of all occurrences fall outside of this range. Just looking strictly at the statistics. Well, if I know that, it doesn't mean it's not possible. Could we get Apple to make another leg to the downside? Sure, it's possible, but we know it's only going to happen 13.6% of all occurrences. In all likelihood, when you start to see yellow bars here, you're going to see the market start to stabilize or even reverse in the other direction. If I go back to see this move on the upside here, okay, what did we see happen on the pulse? We saw yellow, green, yellow again on the pulse, and what happened? Price, it didn't happen immediately, didn't happen overnight, but it did eventually roll over and gave us a nice pullback to the downside. Now we're seeing an oversold condition. What I would anticipate here on Apple is to either find some areas of support, find some consolidation, or even get a nice quick bounce to the upside. And guys, I keep stressing this because I don't want you to misinterpret this. When I say I'm expecting a bounce, I am not expecting Apple to give us a meaningful bounce for the next 4 weeks. I'm saying what's going to happen over the next couple of days. Okay, do I think the market is out of the woods yet? Do I think the worst is over with? No, I just think in the near term, we could very well see a bounce. So how do I play that? Do I just come in and buy a long call option? No, I don't want to do that because if I buy a long call here on Apple, I've got one way of making money. The stock has to move to the upside. It's got to do so quickly. I want to have a more forgiving trade. In this market with all the back and forth movement, we've had head fakes in both directions. I want to have a more forgiving trade that would give me multiple ways of making money. So here's what we're looking at doing. If I jump over to the trade page, I'm going to go to the May 20 options. These have 9 days left expiration. This is going to be a very short term trade. I'm going to use the May monthly options, but because they only have 9 days left, these are essentially a weekly option. Right? So if you take a look, these options are going to have extreme time decay, which is good for us if we use a credit spread. They're also going to have high gamma. The gamma tells us how quickly the options are going to react to changes in stock price. If we get a bounce over the next couple of days, these May options are going to be much more reactive versus going all the way out to June. If I go out to June with 37 days left, if I get a bounce over the next 2 days, unless it's just a phenomenal bounce, it's probably not going to be enough to get me into that profit range. So it's a big mistake that retail traders make on the option side. They don't select the right strategy or the right expiration cycle that matches up with their outlook. They're either going too short term with their options and not giving that stock enough time to move in their favor, or they're going out too far in time when they might only expect the stock to move for the next couple of days. So you really want to make sure that matches up. Like I mentioned, I'm only expecting a move for the next couple of days, so I don't mind using these May 20 options. They only have 9 days left, but because I'm expected to be in and out very quickly, that one definitely meets my outlook. It's an aggressive trade. It's either going to work right off the bat or we're going to be underwater very quickly. It's a higher risk, higher reward type of scenario. So I'm going to go to the put options on the right-hand side. I'm going to go to the 148 puts, okay? They have a 65% chance of closing out of the money. I'm going to right-click on those, go to sell, and I'm going to select vertical. It's going to pop up an order down at the bottom. By default, it has me selling the 148 put and buying the 147 put. I'm going to change that long 147 put to 146. I'm going to keep this as a $2 wide spread. I'm selling the 148 put, buying the 146 put. This one is trading for 52 cents mid-price. If I get filled at 52 cents, I would be risking $148 to make 52. Right around risk 3 to make 1. On my credit spreads, I like to be in that risk 2 or 3 to make 1 range. That one meets my criteria. If I start to risk 4, 5, or 6 to make 1, definitely more difficult to get the numbers in your favor. So this one does meet my criteria if we fill at 52 cents. Now, it gives me a neutral to bullish position, meaning I don't care if the stock moves up, down, or sideways. It doesn't matter to me as long as price stays above the short strike at 148. And actually, we can take that one step further. Our break even's at 147.48 because we're going to take that 52 cent credit that I'm opening the trade for, and I'm going to subtract it from my short strike, and that gives me my break even. So again, up, down, or sideways does not matter to me as long as the stock stays above 147.48. I also make money from time decay adding up. Every day that passes, that helps me. And I also make money if volatility decreases. If we do get a bounce higher in equity, specifically on Apple, what's going to happen to volatility? It'll most likely contract. It's already high. We're expecting it to contract on any type of a bounce in the stock price. So I have 5 ways of making money on the position. With volatility so high here, the options are more expensive. There's more premium to collect. That's why I prefer to use the credit spreads. Not only are they giving us a more forgiving trade, I'm also able to take advantage of the high premiums and push my break-even point further out. If I just come in and buy a long call here, they're more expensive. I'm going to pay up for those, and I'm going to need a bigger directional move in my favor to offset any type of volatility contraction. So instead of forcing that to work, now I'm taking what the market's giving us. And in this case, it's using the credit spread. Now, let's say I do get filled at 52 cents. How do I manage it? My target zone is when I can buy it back and keep between 50 and 75% of the max profit. In other words, if I can buy it back for between 13 and 26 cents anytime over the next 9 days, that's what I'm looking to do. That would allow me to keep between 50 and 75% of the max profit. On a lot of these trades, because we've had so many head fakes and so many false moves in this market, I have been targeting 50% of max profit. So in this case, I'm going to create my closing order right away at 26 cents. As soon as I open the position, if it's at 52 cents, perfect. I'll get my closing order working right away at 26 cents. That would give me the 50% of max profit level. And I'll set that as a GTC. I'll set it as a good till cancel order. That way, over the next 9 days, if I see that stock move in our favor and the spread comes in for us, I want to be able to have that order working just in case I'm not by my screen all day long and we get one of these really quick moves market wide. I want to have that closing order working just in case. I just don't want to miss something. So I'm going to get that order working right after I fill on the position. So that's Apple. It's a neutral to bullish trade. Worst case scenario, I should point this out. If we are dead wrong, let's just say the market does end up completely collapsing over the next 9 days. The most I can lose on this trade is $148. Right, if I'm dead wrong. The only way I lose that entire $148 is if I hold all the way up to expiration. If I close out early, I always can do that and take a partial loss. Now, I like that because in this case, I hear so many people right now going to the sidelines saying, Mike, I don't feel comfortable in this market. It's just too risky. Well, this is a way to stay active. I don't want to go to the sidelines. As a full-time trader, I need to be active. Right? When volatility gets high, I want to take advantage of that as an options trader. So in this case, am I willing to put in thousands of dollars in a trade? Maybe not. Maybe you're not comfortable with that. But in this case, if you want to put it on with very small size, your max loss is $148. Right? That's not going to break you. It's not going to wipe out your account. Can you trade multiple contracts here, multiple spreads? Sure. You can really customize this and really fine tune it to your position size and to your risk outlook. What I have found in the past, when I go to the sidelines, it doesn't happen all that often. In many cases, it'll be a couple times a year around a holiday where I'm just trying to take some time off. I don't like to go to the sidelines because when I go to the sidelines, I find that I lose my discipline. It's really easy to fall out of my normal routine. If I were to put a position on with one spread here, okay, that would be very, very small size. Normally, I'm trading multiple spreads. But let's just say I put it on with one spread. even though it's only $148, because I've got hard-earned money on the line, you better believe I'm going to stay disciplined. I'm going to come in, check the trade. I'm going to manage the position. So even if it's with very small size, smaller size than you're used to, stay active. Put positions on. It's going to keep you engaged in this market. It's going to help you stay more disciplined long term. There's opportunities to be had right now, guys. Yes, you have to be cautious. Yes, you have to control risk. But if you just stick to the rules that we outline in our training and what we talk about in these videos all the time, there are definitely profits to be made right now. So if you have any questions on this Apple trade, let me know. Feel free to post a comment here on this video, or you can email me directly. Mike@netpicks.com is my email address. I'll jump back on next week and let you know how we end up managing this position. Good, bad, or ugly. Hopefully it's on the good side for us. All right, so I'm going to wrap this video up here. Again, I'll be back with you guys next week with our next video. We'll talk to you then.